Good evening, everyone. Thank you all for coming to the sixth session of How to Start a Startup. This session would be on funding and the legal aspects of business. So, just to give you a background of how we in fact contacted Anand Daniel. Anand is the partner with Accel Partners, and Accel obviously needs no introduction. In fact, we contacted Raghunandan, who was the founder of Taxi for Sure. We WhatsApped him and asked him, can you please connect us with a big VC who can take this session and who would be really fit for this entire series. And within few seconds, he replied, there is no other person who can take this session better than Anand. Anand is the rock star of the Indian VC ecosystem. And thank you very much, Anand, for coming over here. Just to give a brief background of the fund and Anand, uh, Accel Partners has really good investments in Taxi for Sure, Ola, and Anand has personally been part of Swiggy and Taxi for Sure, and truly he is the rock star of the Indian ecosystem. And please welcome Anand.
Thank you. Thank you. Yeah. Yeah, thanks. Can you hear me? Okay, I can't live up to any of that, so drop all the. Thanks, Ujjwal, for making up a very good story there. But Raghu, yes, we did back, and we're very excited to have been part of the Taxi for Sure journey. We'll talk a little bit about that today. So I know we have about 1 hour, uh, 40 to 45 minutes, and Q&A, right? Followed by Q&A. So how I'd encourage you to do it is I have a few slides. So let's keep it interactive, right? So it'll be good if something is not clear or you want some clarification or you have a question just to ask it then and there, not necessary to hold it all the way, right? So I tend to forget questions very easily, so don't do the same. So what I'm going to cover is a few things. I'll give a quick intro of Accel, mainly so that you have context of where we invest, what am I talking about, right? Just to set the context. Then we'll go into something that is important for you to understand before we talk about financing and legal. So what are the key elements of a successful startup? Be it whether you're looking to start, whether you're wanting to join a startup, or as an investor, what do we look at, right? So it's very few simple things. You already know about it. And I saw the crowdsourced set of questions, and there was a question around that as well. I want to lead with that because that's an important thing. How many of you, before I start, want to do a startup or want to do a startup post IMA? Okay, good number. It has increased since Raghu asked. I don't know what happened. Yeah, and I saw that video. How many of you want to join a startup? Okay, there are a few people who have lifted their hands. I don't know. Maybe you've already done a startup. Like, I'd love to learn more. But for the first two categories, whether you want to join a startup or you want to do your own startup, hopefully the key elements of a successful startup, let's discuss that a little bit. And then we'll go and discuss about financing, which is one aspect of the successful startup, a smaller aspect, but good to understand. And then a little bit about legal. Upfront disclaimer, I'm not a legal expert. I'll just give you a high level what are things you need to think about as from a legal point of view. Okay? So, and then as we go along, if you have a question, I think we have some mics, we can ask them out. Okay? With that, this is more a quick intro. So Accel's been there globally for 30 plus years. This is what we call as the Accel home screen, some of the successful companies that as a fund we have been fortunate to back globally, right? So we were the first investors in Facebook. Good to see Facebook there. I hope it's for all the sessions, right? So, but that's one of the many that the India team couldn't take credit. It's part of the global team, Accel US's investment, but we're proud of the whole set of investments here across US, UK, and India. US for the whole of Americas, UK that covers UK and a little bit of Israel, UK, Europe, and Israel, and part of the India team here. In India, we've been here for 10 plus years, managed close to $1 billion, slightly north of it, and across these 5 funds. The most recent fund was a 50 million fund, which we just announced recently. We have the 100 plus investments. We mostly start out as seed investments. How many of you know about seed, Series A, and all that? Pretty much. Okay, after class. That's good. So we'll talk about this. What does stages of funding mean? But seed is probably the early stage of the investment. You can and we'll go into more details about that shortly. So 70% of our companies we start out as seed investors and continue to back the companies over time, including Taxi for Sure was a seed investment. Any questions so far? Okay, and these are some of the investments we are proud of. There are a lot of them we are proud of. A few of them, hopefully, you know most of these names. And good to know that Taxi for Sure, Ola was part of this class earlier, and then I think Girish was also here. Fresh Desk, so good. So two of the companies that are marquee investments from our fund have been here. So we'll touch upon those companies as well as we go along. And finally, these are the areas we tend to invest, right? So consumer, mostly it's technology companies. Technology meets any of these sectors. It could be consumer, it could be finance, it could be India business to business, it could be healthcare, right? Or global SaaS. So Freshdesk falls into the global SaaS. Consumer, we already talked about Taxi for Sure or a Flipkart, Myntra, all that. Fintech, it could be any technology that serves the financial services, financial technology side of things, right? If you know JustPay, there's a bunch of things which would touch you, but it'll be kind of maybe second order, not direct consumer, right? The Auto is online to offline. So Swiggy is an online to offline business, right? So it gets the service online and then takes the delivery happens offline. Yeah, good. And mobile is mobile-led consumer companies, and marketplaces is anything in the marketplace model where you don't necessarily own the inventory but become a marketplace and connect each. Good question. Yeah. And then finally, India B2B, that's one I'll call out. So these are companies you met one, Suhail, right? So from Delivery was here, if I'm not mistaken. No, Sahil, sorry, Sahil from Delivery was here. That's an India business to business company, right? So where they serve Indian businesses. Another example in our portfolio is a company called Black Buck that provides intercity logistics, and it's actually a marketplace as well, but the customer is Indian business to business. Versus global SaaS is mostly selling software and mostly selling globally, like Girish used for met with, right? And then healthcare is anything in health technology. It could be devices. Yes, please. Yeah, sure. I'll speak louder. Okay, good. Yeah. You're able to hear better now? Good. Okay. So just to repeat, global SaaS is global software like what Girish, Freshdesk, that class. Healthcare is devices, diagnostics, health IT, information technology. Anything that technology meets healthcare is a game for us. We invest in these. These are the 5 broad areas that we are focused on currently. It doesn't mean these are the only areas we invest in, but these are majority of the investments. Right? We have companies in robotics, we have companies in other spaces also, technology-led companies. They probably broadly won't fall into one of these categories, but they are also interest areas. Any questions so far? These are all the slides I had just to set context of Accel as well as where we invest in. Any questions? Okay, so if not, then we'll jump into the next aspect. We'll spend about 5-10 minutes here. We're going to talk about what are the key elements of a successful startup. I'm sure you have heard this hopefully many times through the many entrepreneurship courses as well as through the series currently, but still want to touch upon it because it's very key to understand it, both if you're looking to start a startup, join a startup, and in my case, how do we evaluate startups? So from all 3 perspectives, this is very important. So the first thing that I think one of your speakers spoke about is team, right? So that's the number one thing. So let's read the 4 things: team, market, the product, and finance. Financing, how do you finance your companies and all that, we'll talk shortly. So we won't touch upon that in detail right now. But the first 3 things are probably the most important thing as you look through and pick ideas for you to either work on or for you to join, right? And in my case, how do I evaluate companies? So the team point of view, all of you are here. It's a very pedigreed school, one of the best in the world, right? So team-wise, it'll be very easy for you, first of all, your background yourself, as well as some of your classmates, as well as your network, if you tap into, to be able to get a bunch of good, smart people. But when we look at teams as investors, what we look for is complementarity, right? So it's not necessary that you have 5 of the same type, right? I've seen many engineers get together and form a company, 4 engineers, right? Start a company saying we are 4 co-founders, right? Same thing has happened. I went to MIT Sloan, right? So where I actually worked on ideas, started companies, co-founded and all that. It used to be four or 5 of my classmates, very similar backgrounds, right? All smart, but not necessarily complementary. So when you look at a team, it's very important to understand what business you're building and to get complementary co-founders. And I think one of your speakers spoke about it earlier. 2 or 3 co-founders is a very good number, right? So one of you brings the technology side of things, one of you brings the business side, another brings the operational side. So that's a good number, and it's important to remember that when you construct the team. And what are the roles? Roles as in broadly, I'll take care of technology, you take care of getting the business in the door, and the third person makes sure of execute. I'm just giving you a very high level overview. And obviously this changes in context from company to company. If you're building a B2 consumer company, that's going to be different from building an enterprise software company, different from healthcare company. So the skills required, particularly the technical skills and the sales skills and even the operational skills, are very specific. So team is one of the most important things we look for. Any team related questions? It's an important one. Okay, so yeah. Sure. So one one is a very tricky number. There are big companies built with just one also. One is a very lonely one. Raghu talked about when he was here. So from that point of view, one is not necessarily a great number to begin with, because startup journey, irrespective of all that you read in the press, has a lot of downs as well as ups, right? So for the downs, it's good to have your co-founder to lean on, right? So 2 or 3, mainly because if you take, say, co-founders more than 4, 5, let's say you have 4 or 5, or let me flip it around. If it's 2 or 3, even with 2 or 3, as the company scale, one of them hopefully scales to become the CEO, and the other 2 fit into specific roles. What I've seen is if it's a lot more than 2 or 3, it's normally a lot of redundancy. So there's 2 people in technology, 3 people in technology. I'm not saying you cannot slot them into specific roles, but there won't be enough meat for them to own and drive. And then they'll start becoming what's called as free riders, right? If one of the co-founder is that, right, initially all of you are important, but as the company scales, maybe one of them is not adding that much value. What do you do? Then there's a lot of angst among the team. And then if I look at our portfolio, the few cases where the companies have not worked out, right? And the nature of startup business is many won't work out. Those cases, a high percentage is because of founder friction. So even in a well-working startup, there's always friction between founders. If it's 2, 3 people, it's manageable. You can still make it work. You can find enough good roles and keep going. But if it's a lot more than 3 or 4, one of them becomes redundant. The other 2 start, other 3 becoming start getting anxiety boarded. They start a lot of disconnect, and then small things lead to bigger things, and the whole startup ends up failing. So from that point of view, I would say 2, 3 is a good number. Yes, there could be a case like there are success stories. Infosys had many founders, right? So in services, in businesses where there are a lot of verticals, you can find good roles and put. This is not like thou shall not have more than 3 founders, right? This is not a written like rule, but this is more a guidance. You have to look at what you're building and see if you need more than 3. Very few cases you need more than 3. There are a couple of follow-up questions. Let's take that. Yeah. So the question is, skills is very easy to analyze. Do you look at personality types as well when you invest in founders? Actually, we look for, not scientifically, short answer, but skills is also neither one, skills or personality is not scientifically. But when we interact with the founders, we look very closely on how are they gelling, right? So when you pitch, right, you might not agree with your co-founder all the time, but are they cutting each other off? Are you overwriting, overtalk? So those are all the signals that we look for, right? Because it's like in any relationship, are they respectful of each other? Like when you're pitching in front of a potential investor, if you're not respectful, if you're trying to show I'm smarter than him and all that. Those are personality traits you can identify. But having said that, these are not super strong. Very rarely do people do such things, but it's important to understand those nuances. And then for the CEO, we do ref checks. For any of the founders, we do talk to people who know them to see who will scale up as CEO, who will say scale up as the technology head, or various roles we talked about. Yeah, you had a question there. Yeah, yeah.
whatever they are trying to do, or
As you, as a founder, you're seeking a co-founder. Should you find someone with experience in that particular space?
no.
Yeah,
My question is, suppose two people come to you,
yeah,
they want to do something in healthcare,
yeah,
but they don't have any experience, experience in healthcare.
yeah.
So is that mandatory or?
Good question. So there are areas, the space you have picked is a good example, healthcare. Let's say you're trying to build the next cancer diagnostic device. We have a company called Mitra Biotech, which does, which predicts with high accuracy whether a particular drug will work for someone's cancer, right? So it's a very specific solution for cancer. So that was, the co-founders were both postdocs from MIT, Harvard, who had done years of research there, right? And founded that company, and we kind of we seeded them in an early stage. So if someone from, let's say, no healthcare background, no technology background in healthcare, had come and pitched the same idea to us, it would have been a lot harder investment decision to make. I'm not saying we wouldn't do that. So there are specific areas where a lot of know-how, expertise is needed in that specific area, and that is what helps. Like they had done 6-7 years of research in cancer before starting this. So those specific areas, particularly in healthcare, or even in some of the enterprise software, we'll talk about Girish shortly and Freshdesk, right? He had experience building a product in in the enterprise software space. So there are spaces where experience helps, and there are spaces like consumer where being young and wanting to change the world works, right? So it depends, and it doesn't mean that a very experienced person won't be able to do a consumer company, or vice versa. A very young entrepreneur cannot do a healthcare company. The one thing I know about investing is there's no set rules. There's always, like, if it's a very set pattern, then it's anyone, like a computer can do it. It's not like that. It's always about a gut call. Can this team do? So, but in broad strokes, if I were to paint, I would say there are IP-led, we'll talk about IP and patents and all that, but IP-led areas where experience and domain expertise really helps. Yeah? Maybe one more questions on team. Yeah.
Particular area of expertise they lack something,
Yeah.
do investors also add value in a way by networking them to right people and or putting people in their teams?
Sure. So as long as you meet that 1-2 co-founders, the question is, can investors help with appending to the team? Absolutely. So we have in our Accel's team, for example, we have about 10 people whose job, these are all senior people, what we call as operating partners or venture development team, who go and work with our startups in helping across areas. It could be recruiting, which is what you're talking about, to help identify the right people, or it could be marketing, it could be technology, it could be finance, it could be different areas. So various investors do help with that. But having said that, your job as the founder is to find that core team. So before you find money or how you're going to run it, find that first. Who are the core people? Be able to, as a founder, the biggest thing is storytelling and convincing, that is being a good storyteller and being able to sell yourself. If you saw all the entrepreneurs, they told you amazing stories, right? Hopefully you all sat in on most of this. So they're all very good storytellers. They can capture the audience and get people excited about their idea. First people you need to do that is your co-founders and your first few employees. So I would say that is a thing that I at least personally look for when I talk to a founder, as in how good are they in inspiring confidence in getting a team together. Because once you have the right team, money is a commodity, you'll get it, right? But getting the right people to come and passionately work with you is the more important thing to build something huge, right? So long answer, but it has more to it. Maybe we'll stop on team for now. We'll go and come back to team unless there's any other pressing question on team.
Yeah. Just one very quickly.
Yeah.
Between the co-founders, is it just an informal understanding between them, or there is something formal to be established between them?
Initially.
Yeah.
Sure, we are going ahead here on the legal side, but we'll touch upon it right now. I would say that once you're clear, you're doing a company, in idea stage, you'll always be ideating. There could be like 10 ideas, 50 ideas you go through. And you might not end up starting a company with that idea. In that phase, it's okay. Just get together, ideate and all that. But once you're clear, this is the company I'm building, right? So, and I want to start spending time, real time on that. So at that phase, it will be a good idea, at least, even before you register your company, to broadly at least have an understanding of, is we are the co-founders, this is the equity, and this is how we are splitting the equity among the co-founders, and it need not be all equal, right? So what is the ratio of the equity, who's going to be CEO, have a lot of detailed discussions around it. Don't do it too early when you don't know if that same person you're going to co-found with, but when you're actually doing it, I think it's very important to do that. And then maybe even to formalize it, what's the vesting schedule? If, let's say, after 1 year, one of the co-founders is going to leave, you don't want them going away with 30% of the company. So it'll vest over 3-4 years. When you do go in for an investment, that happens. Vesting is, the shares is yours, but it'll come to you over time, right? So it's a good practice even as founders when you do this, to do that, say that, we'll split it in this ratio and we'll get it back over 4 years, right? Yearly, monthly, whatever. Yeah, good question. Okay, so now the next thing is this most important thing. So second most important thing, or however you want to look at it, it's a toss-up between team and market. So there are some investors who say that if it's the right team, they'll figure out the market, and there are some investors who say if it's the right market, the team will we can figure out the team. But I don't think there's any right one answer here. But the important thing is to pick a market idea that's, at least if you're trying to build something that is venture backable, VC funds and others will back, this is one of the most important things to think through. This is not important for, like I'm assuming most of the people here want to join a startup that's either scaling a lot, or you want to do a startup that scales a lot. This is not applicable if you want to build a startup that gets to, let's say, 5-10 million in revenue, profitable, and goes on like that. That's not necessarily, and majority of the businesses in the world fall in that category. And these are really profitable businesses, like millions of them that do anywhere from $1 to $10 million and profitable, and the founders are very happy, and it's scaling, right? Scaling at a more slower level. Those are not the businesses we are talking about. We are talking about businesses that were the entrepreneurs here in this, who came and talked before, built, right? So for all those businesses, market size is the most important thing. And market is the most important thing. Market comprises of a few different aspects. One is, who are you selling to? So is it a consumer? Is it an enterprise, right? And like we talked about healthcare, is it finance, which particular sector? And then how many of them, how big is the market, right? So it could be in terms of purely numbers. So if you look at the Facebook example going back, it was purely eyeballs. How many people will use it for a long period of time before actually it got converted into a dollar aspect, because of the business model. Business models could evolve over time. So there are businesses where it might be eyeballs driven also, and there are businesses which are dollar driven. So there are various different kinds of businesses. So it's tough to go into each and every aspect today. But we'll talk about two businesses at least that you have studied already, so that we can look at it from a market perspective. But it's important to understand the size of the opportunity in some shape, like it's either in number of people or dollars most broadly, and is it large enough? So that is one. And then is it scalable? So it could be a large opportunity, but it might not be scalable. It might require selling to 1 million people going door to door. If so, it's not a scalable business, right? Versus you might not make a lot of money per person, but it can scale to 100 million people very quickly, because they'll discover and buy on their own. That's a scalable business model, right? If anything I'm saying does not make sense, stop me and ask me. I can give you more examples. Okay, so when you look at market, it's how big is the opportunity broadly, and is it a business model that can scale, and can it become large in a reasonably short period of time, which means 5 to 7 years from most venture investors' point of view. Can it achieve real good momentum? So that's something we look for very, very closely. So 98% of the businesses that doesn't pass through to more serious consideration, we look at a few thousand businesses every year, but 98% of them doesn't pass through to the next level, mainly because of this market reason. It's not so much the team, it's not the product, it's not anything else. So the other couple of things are here as well. Yes, you had a question. Sorry?
So the 5% that you're talking about, so how do you define that? What's the quantum you're looking at?
5% what?
The 5% of the businesses who have the potential to sort of scale up to.
Yeah, market potential, right?
So how do you define that? That is the potentially a business which can reach 100 million mark. Like, how do you
Good
set
question.
that cap?
Good question. So the very good question. What is this market that is big enough is your question, right? So I told you that the market needs to be large enough so that the investor gets excited. So your question is, how do you define that? What is that number? Is it $10 million? Is it $100 million? Is it $500 million? Right? So in the Indian context, I would say a market that's 100, 200 million at least is the base for most VC investors, right? What does that mean? If there are 200 million people willing to spend $1 per year with you, that's a $200 million per year market. Very broad strokes, right? If there are let's say a million people willing to spend $200 with you on a yearly basis, that's still a $200 million market. Or it could be 10,000 companies willing to spend whatever that multiple is to get to the same 200 million. So any of these, so whether it's B2C, business to business or business to consumer, figure out how many people you can sell to, how much money you can make per customer. Very simple math, multiplying those two, you'll know what's the size of the market. And the way to verify that is, I'm sure in business school you've been taught multiple top down, bottoms up and everything. But in most cases, if you look, almost everywhere, there's already an alternative. If you look at taxi for sure, it went and disrupted the taxi market and Ola now, right? So, but there was already taxis being sold. How many taxis were running? Like those are the kind of things. We'll talk about that. So similarly, in the case of a fresh desk, we'll talk about 2 cases at least, so you'll get more perspective there. But very good question. And one other angle there is a small angel fund, which is $10 million, might not have a very large market size requirement. Whereas the larger funds, which or majority of the funds that you might be targeting, might have a larger market size requirement. So when I say 100 to 200 million, it's more like a broad average. I would say 200 million as an average for India. If you go and ask the same number of a US investor, I used to be an investor there, it's probably more like $500 million to $1 billion as the minimal market potential. So for investors to get excited. So it varies from geography to geography, varies from the kind of investor also.
Does it also vary by the amount of seed equality?
The market size?
No. If my company doesn't want to do 200 million, but wants to 75 million, and I need lesser amount of funds, would you consider that? Is it a function of the amount of money
Being raised. Got it. Very good question. So this is a more technical answer to it. I'll try to answer it. If I'm not clear, we'll try again. So the market size thing, it's fundamentally because of the way VC funds are structured, right? So VC fund, if it's a $100 million fund, they're expected to return a multiple of that 100 million, right? So they're expected to return at least 200, 300 million or more. So when you have to return $300 million to your investor, VC funds at the end of the day are fund managers. Just like any, any mutual fund collects money from consumer, like a lot of retail people and investors. Similarly, VC funds, we raise funds from a smaller subset of investors, and we'll have managing it, investing in startups, and we'll have to return multiple of it. So I'm setting the context because that's relevant for the answer. So the size of the market, 200 million that I talked about, is because most VC funds will have a target ownership, which is the ownership they want in a company. Let's assume it's 20% for the sake of math. It's also a good number which most funds will want. 20% if you own of a 200 million outcome is a $40 million, right? Are you all with me? 20% of 200 million is a $40 million outcome. If you are a 100 to 200 million dollar fund, if you can return 40 million, is a reasonable size of money. Obviously, if it's bigger, the better, but at least 40. Then, if you return, if you're 100 million, if you return two and a half such investments, then you return the fund, but you still have to return a multiple of it. So fundamentally, this 200 million math and all that is mainly because of the size of the fund and how the funds operate and how they have to return money. So it has nothing to do with how capital efficiency matters, but if you can take lesser amount of money, if you can, instead of raising 10 million, I can raise 5 million, and instead of exiting at 200, I can exit at 100 million. Will that work? Is your question, which is a very good question. But unfortunately, because of the math here, it does not work. The fund size does not change. So the funds more or less, or like if they raise a 200 million fund, it stays that way. So for them to be able to return a multiple of the fund, you'll have to go after markets that are large enough so that if you return 200 million, or let's extend that out. If it's a $1 billion outcome, if you own 20%, you own 200, that VC fund makes 200 million in that one investment, then that returns that whole fund, right? So that is the economics. So it's okay, it's not scalable from that point of view. You can't invest lesser, and vice versa. A VC fund. So the other thing to note also is VC funds are supposed to make 20 such investments. If a $200 million fund, you make 20 such $10 million investments, roughly. That's the portfolio theory, and hope that, not hope, work towards that. Some of these companies, right, returning these kind of multiples. So they can't go and invest less in one certain companies, or they can't go and invest a lot more in certain companies also. So that the portfolio theory will also break. So from both perspectives, it's not possible to scale up or down. Okay, I covered two concepts, technical. If any follow-up, please ask. Yeah.
You talked about reaching to a figure of $200 million.
Yeah.
Yeah. So what is the time horizon by which you expect that figure to be reached?
Good question. So we'll jump ahead, and I'm going to answer that in the interest of time, right? So I'm going to jump ahead and answer that. Okay. So the other things we look at is product, business model, traction. We'll touch upon that in the context of a case study. Okay. So the first one is a company called Freshdesk, which you already know, right? So your question is this time horizon to exit. Why I'm coming here is this company we haven't exited, right? Short answer to your question is VCs invest between 5 to, like, our funds are 10-year life cycle. We invest over the first 3 to 4 years in new companies and work with those companies towards an exit over the subsequent 5 to 7 years, right? So the overall window, if you caught us early in a fund cycle, if you invest in year 1, by year 10, we should absolutely have exited, right? But if you caught us in the 3rd year, then we have 7 more years. So that's the answer there. Now coming back here, I want to touch upon a few of these things in the context of what we saw in the previous slide, right? So you already met Girish, right? Most of you are hopefully there at the session where he talked about. So and hopefully you realize that he had a lot of experience from Zoho, building and scaling enterprise software product, SaaS product. So that was very important to us when we looked at him as a team person. He's a great storyteller. He's like, he can inspire and confidence in not only investors but employees. He had a small but a very passionate team with him when we met him initially. And he has co-founder Shan, who's a very strong technologist. So going back to the team thing, so multiple things lined up for us to really like him. He didn't have a lot of traction. It was very early, right? He had a product, but the product vision was very clear, which is the second thing. Are you solving a very important pain point? And is that a very good product that you're building? So that's, as a technology focused venture fund, we spend a lot of time analyzing the product, because when team and market kind of is, those bars are checked, right? Then the important thing that differentiates is the actual product itself. So in the case of Girish and team, they had built a really good product when we initially looked at them for the first round of investment. Market potential was very clear. It had $1 billion plus potential globally. right? So that everyone like a lot of companies bought customer support software, and that was our estimate of the market. And finally, the business model is how they were going to make money in that particular market. They were going to charge at that time $30 to $50 per agent per month. That was the SaaS business model, software as a service business model. We can happy to answer any detailed questions on any of these. Finally, the seed investment when we made the $1 million, they had about 70 customers. I don't think any of them were paid customers at that time, but slowly over time they started scaling. I only marked here the first couple of rounds of funding because this is something I want to touch upon. So I'm giving you examples, then we'll go and talk about what do each of these stages mean: seed, series A, series B. These are all evolution of the company that they're scaling, and they're adding more customers, more revenue, and as they do that, they raise more capital. Any questions on Fresh Desk? Yeah. Sure. So what Girish did was he's a very good product manager. So he went and really analyzed the products out there, and particularly Zendesk, and realized that they weren't providing a few key features. One of them being social media. In those days, Twitter and Facebook, people used to go and very rarely people go to Twitter and Facebook and say good things about companies, but bad things about companies everyone says, right? So that a lot of that bitching used to happen, but that was not tied to the customer support side of things. So customer support was mostly call center enabled at that time. So he saw the gap, saying that I need to tie social media to this thing. In fact, he has a very long, good story about it. He's a better person to say how he was doing shipping a TV or something, it broke, and to just get attention of the company, he had to go to social media and tweet about it, and that's how he got the attention of the company, right? And that's when the idea stuck. Why don't we connect both? So social media and customer support. So that was one of the features. Like that, he had a bunch of smaller things also. So it was more features within a broader product. The second innovation they did is to say that we'll build a much better product from India and sell it only purely over the internet to the globe. Zendesk was selling predominantly to developed markets, to a few big countries, whereas they wanted to sell from day one across the globe in multiple languages. So that was a business model innovation. And the third was even the pricing. They had very innovative pricing on freemium, like how can you start free, or how can you start with $1, like various pricing models. So he had a few different things, but mostly this product, business model, and pricing. Okay? Yeah. 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 Mm-hmm. Got it. Yeah. Or you're talking about sustainable differentiation, right? So sustainable differentiation is an important factor in general in investment. But if you look at SaaS or consumer software, it's not patents or anything that's going to protect you. Unfortunately, it's your speed of execution. And I'm saying unfortunately because you can't protect it that way. But the way you protect it is by your speed of innovation and speed of execution. So if you say I've got the perfect features, you're out. You're going to be dead soon because someone will copy it within 3 months. Sorry. But in the case of this company as well as most consumer companies, it's rapid execution as well as innovation is what keeps them ahead of the game. Yeah? Okay. Any other questions? So if not, we'll go to Taxi for Sure. You met Raghu as well. So that's another story you're very familiar with, and I am a grad as well, right? So here in this case, the team, you know them. They were reasonably complementary to each other, but they're not necessarily from the domain, right? So it was a consumer problem. They felt it as a consumer, and they wanted to solve it. They knew technology can enable it, so they set out to solve the problem. When we, as a product, they initially started with phone calls, but quickly launched or over time launched the mobile app as well. Web and phone calls were the initial one, and then they launched the mobile app as well. But when we initially invested, it was mostly the phone and the mobile side. Okay, and we initially investigated the market, counted the number of cabs, and did a lot of top-down, bottom-up analysis. Our analysis was this was I think roughly 300 million kind of a market, and growing, right? So it's not only online, but online, offline, everything, obviously at that time. And finally, the various stages of investments. So we invested at the seed stage, where they were doing. It was actually two people, Raghu Apramaya and one other hacker, in a small, like in the roof of a home, right? That's where they were, or a roof of a building they were working out of. So, but even then, they had a 50 plus transactions per day. And in fact, when there were times when the cabs didn't show up, Apramaya used to take the car, or Raghu used to take the car and go and pick up clients and drop also. So that kind of passion was something that we really saw, that they picked a problem and they really want to solve it. So that's what inspired us to back Raghu and Apramaya at that time. Right. So, any questions on this? So, this is actual live examples of cases that you know that touch upon the key elements of a successful
Yeah, I have a
startup.
question. So
Yeah.
you invested 1 million in the series A 3 million and series B 10 million. So how do
Yeah.
you decide at what stage how much should I invest? I mean,
Yeah.
like, so you said rapid execution and innovation is important.
Yeah.
So in order for them to rapidly execute, they need funding to do that. So how will you decide at what stage how much should I fund? If
Good.
I'm coming
Very
to
good question. So this is that leads me to this one. So it's a very good question. So if you look, there are various phases of evolution of any startup. So I'm going to broadly answer it. Hopefully, it'll touch your answer. If not, we'll come back to it. So if you look, there are idea stages. Most of you are hopefully sitting here and thinking of ideas, right? So there's that stage, concept incubation. Most of the time, the cost there is the cost of feeding yourself, right? So it's self, right? And mostly no one outside is funding you at that time. Then comes the acceleration stage, which is a new stage in the global ecosystem where there's a lot of options to go into accelerators and accelerate your startup, right? And then there comes the seed stage. Seed could be funded by friends and family, right? It could be funded by angels, or it could be funded by a few funds like ours, which does seed stage investment as well. So till now, the amount of capital you raise is less. So in the seed stage, is anywhere could be from anywhere less than $1 million, we'd call it as seed, right? So coming back to your question, so most of these from here on, once you raise capital from especially institutional investors, the clock starts. You're probably in the limelight, and you're on a treadmill almost, right? So as in, the intent is not to slowly and over 5-10 years to build a sustainable company. Once you start raising VC funds, the 10-year window of that VC fund is what you have to play with at most, right? Most likely it's 5 to 7 years. If you look at most VC term sheets and documents, it'll say exit in 5 years or 7 years is what is expected, right? It's extendable. They're not going to say you have to exit today, but that's the expectation set. So each stage after that, you raise money for ideally at least 18 to 24 months, right? So how much you raise and what you achieve in that period, whether it's seed, series A, B, and C, D, E, F, like there are companies, depending on the kind of company or space you are in, it depends on the founders and the entrepreneurs who are setting the vision for those years. So if you want to go from, in the Taxi for Show case, from less than 50 transactions to 500 transactions, they wanted to do that in that 6 to 9 month window. They needed $1 million for that. That's what we gave, and they hit that same milestone ahead. Then we put the next phase, which was the 3 million, and they had specific targets they'll hit by then. And all these are 12, 18, 24 month targets to those specific cases. So, and then it keeps going. So when you raise your seed round or series A itself, you know which industry you are in, whether you're in consumer, enterprise, healthcare, financial technologies, agri, whichever industry it is, you'll have a rough sense for what is this a timed opportunity. What I mean by that is you need to be able to execute and get to a finish in a specific period of time, or is this something you want to build over 10, 20 years? If it's something that you want to build over 10 plus years, I would encourage you not to think about institutional funding very early. There's a lot of companies that go on, get to profitability, and then only raise capital from private equity or growth funds, which is very much like a lot of companies go down that route. And it's possible in certain industries. If so, that's a great way. Some companies never raise capital all the way through to exit also, right? There are companies like that. And in the SaaS space itself, there's a company in Chennai called Zoho, which has never raised any capital till date, and it's at $300 million plus revenue, right? So all kinds of funding opportunities and ways to build the companies exist. It's a question of you understanding your industry and what do you want to achieve. Once you're clear about that, if you pick an area where you want to grow a company fast and exit in 5, 7, 10 years, then institutional funding makes sense, right? And then you work back and say that my estimate is over the lifetime of the company, I need about, if you take any consumer company, it's very rarely you can build a large consumer company with less than $50 million, right? Then you have to work back and say these roughly for the next 12 to 18 to 24 months, this is how much I raise. Let's call that seed, let's call that Series A, whatever. But over time, you know how much you need to raise. And if you roughly put, one question to this is dilution and how much you own and all that, right? So when you know how much you're going to raise over what period of time, then you'll automatically understand what is the dilution that's going to happen in each of those phases, right? So one second. And I think, and there's other options in addition to VC, which shows up as you scale the company, which are strategic investors, right? This could be bigger companies in that space or adjacent space who want to invest, or corporate venture capital funds. And thing that I have not mentioned here is there are a bunch of social venture capital funds. Hopefully some of you in the room want to do social impact ventures. And those are also backable and are very much backed by a bunch of social venture capital funds who will invest in you, not only for the profitability of the company, but the impact that the company is going to have. So there are various kinds of funding options that are available depending on which sector you're in. And as an entrepreneur, it's important for you to figure out what is the time frame of me building the company, and what's the kind of exit I want, and what's the kind of capital requirements that are needed for what I'm building. And from that, work back on your capital raising strategy, right? This is important to understand, so encourage follow-up questions. You had one. Yeah.
So, let's say you've selected a company for investment and you've committed seed fund to it.
Yeah.
So, how much role does a venture capital play in terms of raising the next rounds and ensuring that that funding comes? Given the fact that the founders themselves, if they are in the growth phase, hard pressed on their bandwidth, and if they so I have seen a lot of my friends who are in this space who spend a lot of time worrying only about the next round, and they spend a lot of time, and they pretty much a full-time job for one of the founders to make sure that the next round is coming.
Yeah.
So
How does the venture capital fund help with the next round?
Yeah.
Right, is the broad question. So at a very high level, the fundraising and fund management is probably one of the key jobs of the CEO. Among the founders, there's going to be one of the founders, if there are founders, and if there's only one, there's one. So the CEO's job fundamentally is two things, right? There are a lot of things, but two things they can't fail at. One is cash running out, right? Second is the team. So if they build a really solid team below themselves, which we already talked about, where most of their day-to-day operations of the company is taken care of by that team, then their big focus is to make sure there's money in the, money to run the business. So if a CEO founder, you don't realize that and sign up for it, it'll be tough to be in the startup business, right? So I want to preface that before saying what a VC, how a VC can help and all that, right? So fundamentally, making sure capital is there, team is there, and strategically you're heading in the right direction is the job you need to be able to sign up for as for a CEO. Once you do that, and if you, now coming back to your question, how a VC can help, right? In the funding side of things, if you pick the right VC, that's one of the questions we can touch upon as well, right? Hopefully, when we, like, let's say Accel, if we invest $1, right, we reserve X dollars for that company. What that means is we have put in this much, but we're going to put in so much more over a period of time in that same company. So if we did the seed round, So if you look in the Taxi for Show case, we did the Series A. So we did the seed along with another fund, and the Series A, the two funds we ourselves did the Series A of 3 million. So that doesn't happen all the time, but invariably, if you raise capital from a fund, they're going to, in the least, do what is called as pro rata. Pro rata means if they own 20%, and the next round is $10 million, they'll do at least 20% of that next round. So that most funds do. In many cases, we'll do super pro rata also, which means more than that amount in that particular round. So as a VC fund, we can help you figure out what is your, it's the CEO's job, but we are there to be a sounding board to figure out what is your funding horizon. So 18 to 24 months we've raised. What will we strategically achieve in those 18 to 24 months? When should we go out funding? Because in most environments, funding takes 6 to 9 months. So if you need money in December, we need to go out by March. So all those thinking, and then how much do we need to raise, right? All that business planning, and finally, okay, now that we know all this, we'll contribute this much. We need to raise this, the remaining. Let's go and approach all these funds. So we know most of the other funds. So we'll introduce, and at the end of the day, we'll only introduce, make the connections, but it's the CEO's vision. We are not running the company. The other VC involvement is more strategic and not operational. Not only in fundraise, but in everything in the company, right? It's Raghu who ran TFS, or Girish who runs Fresh Desk today. So we are there more as a sounding board, strategic board, cheering squad, right? So always trying to, not always, but trying to encourage and be there for them behind the scenes, right? So very rarely you hear or should hear about the VCs, because it's always a behind the scenes job, and we don't do much operationally. It's more strategically and guiding and opening the doors in the case of funding, or in the case of hiring or business development. But it's a CEO's job to go and close that. Okay, long-winded answer, but I want you to understand that. Okay, yeah.
So you mentioned about VC's involvement being strategic.
Yeah.
Any comments on the recent Flipkart rejig at the top?
How is that related? Yeah.
So now the CEO, none of the founders are the CEO right now. Flipkart,
Fair enough. Yeah.
Yeah. So Puneet Soni, the ex-chief product officer Flipkart, he mentioned that now it is being run by a VC. And so any comments on this kind of
So let's
involvement?
not stick to any specific company, but in general, see, if you're a founder of a company, right, and you're the founder CEO, right, if you look across the world, like some of the largest companies are where the founders have been CEOs and have gone on to be CEOs for a long period of time, like including Facebook, and if you look, and Larry were involved for a long period of time, right? So most of the time the founders make a very good CEOs, and they scale, and the company scales with them. But having said that, as founders, the question to ask yourself is, am I married to the CEO title, or do I want to see the company do well? Most founders, when we have this conversation, I have it at seed itself, right? Saying that, will you do this job even if you're not the CEO, right? It's the nature of the business, because you don't know at seed stage who will scale, who won't scale. But the real good founders are for building an impactful company, and not about title, right? So we want to have an impact in this particular area. I'll go along with it. I'll be the CEO, do the job of raising money, right, as well as building the right team, right, doing the strategic things. And at some point, in fact, most of the time I hear it proactively, where the founders say that if I don't scale at that point, I'd rather get someone to come and run the company. So it's more a collaborative decision, and in spite of what media makes it, what you read, it's very rarely that any investor, right, the world can suddenly go and say that today you're out. There are signs that will show that the founder is not able to scale. The founder will realize themselves. The good ones proactively say, I want to bring in a CEO, right? But it's very tough. It's a very emotional decision. So many of them need a little bit of, I would say, encouragement, coax to a certain extent also. But eventually, in a few cases, there is need to bring external CEOs. Not only here, across the board, if you see, there's no one right or wrong answer. If you look at it as a movie and then the hero got slain, then obviously yes. But the movie here is to build something which is impactful for decades. If so, who's the CEO and at any given time is not as important as if you're building a good to great company, where great is all about level 5 leaders. If you've not read that book, go read that, right? So who, it's not about them, but it's building, encouraging a team below you and growing it to become a company that will be there for decades. Yeah? And I didn't answer your specific question, but broadly, how do you think about that? Okay?
Yeah,
Yeah.
if for some reason the business is not doing well over a continuous period, then what could really happen? What means the VC takes control, or you exit, or somebody? What could be different things happening?
Sure. If the business is not doing well because of market reasons, right? If you picked a wrong market and trying to do whatever you can, and you're not scaling, then I don't think there's anything that can be done, right? So the entrepreneur realizes it, we realize it, we figure out what's the best can we do, right? Can we figure out someone else who's in the adjacent space and we can figure out an exit, right? Or something like that. Or it doesn't work out, you wind down the company and move on to your next idea, because the most important thing is the time of the entrepreneur also. So nowadays we are seeing more and more young entrepreneurs, or more and more first time entrepreneurs, not necessarily young, saying that this is not working, I want to move on, I want to do the next thing, which is absolutely fine. It used to happen in the Valley a lot. Now I see that happening in India. And we are comfortable backing those entrepreneurs again because they've learned a lot from that first experience. And that's one kind of thing. Second kind is what we talked about, founders, or there's some issues internally and the company is not scaling because of internal issues. It could be team, or it could be most likely team, right? So whatever that means. Then we try to work with the team, work with the founders to try and fix that and grow the company. And I would say almost many of the companies go through, I wouldn't call it team issues, but it's growing. When you grow, you need help, right? So not everyone's going to scale at the same level, but finding the right role for everyone and bringing in talent to top, that's the most important thing that as a founder CEO, the person is going to do, and we'll help from behind the scenes on that. And hopefully that fixes the issue, and then we go back on trajectory. If not, again, for whatever reason it doesn't work, you'll have to exit some shape or form or wind down. Those are so if you look at that previous chart, exit could be IPO, M&A, or shutdown. All three are these are the three likely. It's very clear. It's one of these three. In the rare cases, there are sustainable companies that keep going and going and going. That happens also, but that's very few. Yeah, without any of those. Yeah.
Just like Flipkart, same thing happened with Housing.com, which has recently acquired PropTiger. I mean, I just wanted to ask, like companies like Make My Trip, they are getting listed on Nasdaq because they cannot get listed on in India's markets, mainly because of the regulation requirements or ICDR requirements. So I just wanted to know, is it happening? There are two things. Are they going to Nasdaq because there are not enough exit opportunities for VCs? Now VCs are acquiring or taking operational control of companies like Flipkart or the Housing.com, mainly because they know that the valuations have been coming down. For Flipkart, it came down twice. So they actually want to move to profitability rather than the scalability, so that there are enough exit options, which we were talking about. I mean, is that the scenario how it is building up? Because earlier when you were operating in the US, you like Atlassian or the for the Facebook, you raised enough funds, but that thing is not really applicable in Indian context. So is that the scenario how it is panning out?
So I think your fundamental question is what happens over time in exit, right? So if you look at India, it's and the availability of funds. If you look at India and compare it to US or China, right? So US is probably 30, 40, close to half a century of venture capital investing experience. So India is, if you look at our fund, it's 10 years old and probably one of the older funds, right? It's a very young ecosystem, venture investment point of view, right? And if you look, I don't remember the exact numbers. If you look at 2011, 12, um, there were about a couple of $1 billion invested in early stage venture capital, and that kind of doubled in 14, 15, 2014, 2015. The amount of dollars jumped, right? And then in 16, it went back to the previous level. So if you look at the amount of dollars that are being invested in India, it's across 200, 300 to 500 companies, if you look at serious funding, and it's a couple of $1 billion broadly, right? So, and that is a more sustainable pace in India given where the market is today. Because if, let's go back, it takes 7-10 years to build a company, right? Even if you take a company like a Flipkart, it's 10-year-old, right? Or close to 10 years. And that's one of the longer history companies, right? So Make My Trip built over a long period of time. We have a company in our portfolio called Book My Show. It's built over 17 years or something like that, right? But it takes time to build companies, and because of that, it also takes time to exit. In general, it takes time to exit. If you look at IPO age in the US, it's about 11 years, average years to IPO. So in India, it's not going to be any lesser, right? So given all this data, 2 points. Is there enough capital available for in India, in the startup ecosystem, and to grow some of these companies? I think um, on an average, I think there is enough capital to sustain a broad set of companies across at least the sectors I know about. I know there is enough capital. Um, and is there enough exits happening in India? Not yet. It's very early days. We can point to one Make My Trip, we can point to one Just Dial, right? We'll point to very few, Taxi for sure in the M&A, and then there's a few others like that. But both M&A and IPO market in India is very early. That's one of the reasons why a lot more capital will not immediately flow into India. You have to show the whole cycle, you have to exit, venture capital funds have to return money, multiple of it, then only you'll see more money flowing into India, right? So we are still early in the whole evolution of this VC ecosystem. So it's tough to say. I would say that the good news is because of what's happening with, first of all, the smartphones and all the demographic dividend and all that we have, and geo launching data plans. So there's a lot of good tailwind behind consumer adoption. So the kind of scale that a Taxi for Sure or Ola saw, right? What took 3 years, I'm seeing that happen in newer companies in our portfolio. Let's say Swiggy or companies like that. It's in food delivery in almost half the time. That's hugely, like, it's one is because the entrepreneurs are learning from all the previous generation of entrepreneurs and building companies faster. The second is the market is also ready, right? So because we are trained by Flipkart and Ola and others to order stuff online, it's easy for them to go and order food as well, right? So that's the evolution that's happening. So the signs from growth, that point of view is that. From exit point of view, in India or globally, whether it's the NSE, BSE here or NASDAQ, those are all strategic choices that an entrepreneur makes. When Make My Trip went public, they had to do it there for certain reasons. But nowadays, dual listing is not mandatory. So any company here can directly go and list in NASDAQ. It's more a question of, do you have the right metrics? Are you ready for regulatory scrutiny from the US SEC, and are you ready for are you GAP compliant? There's a lot of work that needs to go behind the scenes to make it happen. So that's why companies, even large companies in the US, decide to stay private for long. So much longer answer we can take it. But all these are things that will evolve over the next 5-7 years. I don't think there are a few cases that you pointed out, but those are all exceptions, and exceptions tend to get more highlighted in the media. Don't go by that. Go by more where the average is, what's happening there. Studying the average will help you understand more of the ecosystem. Yeah? Cool. I think, how are we doing in time? Yeah? No, I'm done actually. So we're taking questions as we do. Yeah. So, yeah. How many more? Yeah. Questions? $10? Okay, sounds good. Okay. Yeah, one lady there. Yeah.
Yeah. So when you start out, when you're investing, you know that all companies won't be equally risky.
Yeah.
So how do you manage that risk at the time of investment? Later on, of course, anything could happen. But when you start the fund, how do you conceptualize how you're going to diversify your risks, or what's the breakdown or the thinking behind that?
Sure. So as a VC fund, we shouldn't try to reduce risk early early on. So if you invest in a company that can return 5x for sure in 10 years, that's not a company that a VC should invest in if it's like project financing type. Most VC funds, or at least I can't generalize, but as VC funds, we tend to look at the things that I talked about. Is this a large market? Can something impactful be created here? Impactful could mean touching tens, if not hundreds of millions of lives, right? It could be in healthcare side, it could be on the finance side, it could be on the consumer side, or it could be touching tens of thousands of SMBs or businesses. So can that scale happen in a short period of time using technology? That's what we look for. If that happens, automatically the company is also going to be valuable. Valuable could mean 200 million, half a billion, $1 billion. If you know precisely what it's going to be, then again, it's not a company I should invest in, right? When we invest in, we're absolutely okay with there being enough risk, because as a VC investor, we should be willing to lose our money that we invest in. But when it works, can it return 10x, 50x, 100x? If you go and study Facebook or any of these companies and you look at the early investors, what's the multiple they got? And when we invested in Facebook, would we have predicted that multiple? Probably not exactly, or not even close. But that's important to know that it's a risky investment, but if it happens, it's going to touch millions, if not billions of lives, and it can create huge impact globally. And because of that, a lot of value is going to get created, and a huge multiple 10, 100, 1000x is possible. Those are good. And from a diversification perspective, only risk diversification we do is across sectors. So instead of risking everything in one sector, we invest across different sectors in reasonably risky businesses, but with the hope that, or not hope, with the intent that these will scale and become large corporations over time. Does that answer your question? Okay. Yeah.
Hello, sir.
Yeah.
I'm Himanshu. I would actually thank you for coming over here.
Absolutely. Yeah.
Because of the background that you are here, I'm focusing my question on investing and the nature of macro level investing in India.
Sure.
So I would like to ask you, when do you see investments in non-tech startups, like specifically in agri or SMEs or manufacturing industries, to get a boost, especially from the VC side, or some investments at the bottom of the pyramid that can actually even help in creating some social impacts?
Sure. See, social impact, there's already investors doing it, right? So because social impact investors raise money from people saying that I'm going to invest and I'll not optimize only for profit as in making the best return, but for what's called double bottom line, right? Both profits as well as for impact. That already exists in the bottom of the pyramid. Not necessarily BOP, but social impact investing. Just Google that. To your question of non-tech investments, right? See, from a VC investment perspective, what's important, going back to the previous question, is the ability to say that the outcome is unbounded to a certain extent, right? It's not necessarily only 3x, 5x, 10x, it could become 100x also. By nature, only tech investments provide that aspect. If you look at anything brick and mortar, it's unfortunately invariably linear. Over time, you can predict that it's the good part is predictable, but it's not non-linear. So given that nature, even if we invest in agri, we have some investments there, or in manufacturing or others, it's more technology meeting that industry is where I see VCs invest, right? So, but growth investors, there are the whole class of growth and private equity investors, do look at spaces where it's more predictable. They want only 3 to 5x, but in a predictable period of time with very low risk tolerance for failure. So that's a different class of investors. But to reach that different class of investors, you need to scale your company to reach a minimum level. So that is the tricky portion there. So you have to unfortunately self-fund, raise from friends and family and all that to get to that stage before a growth or a private equity investor will invest. Okay? Yeah. I don't see the fundamentals of that changing. Yeah. Last question. Okay. Yeah. You've raised. Okay, got it. Yeah. 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 So it depends on the, it depends, good question. When can angel investors start expecting? Is it, so if it's in the tech sector, I mean, so in the tech sector, if it's one of these industries we're talking about, Series A, B, like when that happens, we have given exits to many angels. Mainly because that, for lack of a better way, simplifies the cap table, right? So we want to own, let's say 20, 25%, and the founder doesn't want to dilute more than this much. There are angels sitting who came in earlier, and we're happy buying those. In fact, as we speak, we are doing a couple of transactions where that's happening. Maybe a small discount, but it'll still be up from like 10, 15x from where they invested, right? So it does happen, but obviously for every 100 companies funded by angels, maybe one or two only get to the VC round, right? So that's the challenge. So the ones that are getting there, eh, yeah, it depends on how much also. So it can't be a big sum that goes to the angels, but a smaller amount, yeah. They're actually, yeah, yeah. Yeah, 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 that happens. At least in many of our investments, it has happened. Yeah, yeah, yeah. Yep. And yeah, cool. Okay, thank you guys. Thank you everyone for your time. Yeah. Go.
So thank you, Anand, for providing a hands-on perspective on issues of finance and legal aspects in startups. I truly believe that all of us are going to leave this room with a lot more clarity and enthusiasm about entrepreneurship. So on behalf of the entire IMA community, I'd like to thank Anand for coming down to campus and taking out his time and sharing his views with us. I invite Professor Apurv Nagpal to hand over the memento and a token of our appreciation to Anand. Thanks so much.